Having a successful business or a highly appreciated piece of stock or doing well with real estate can be very exciting, but what happens when it comes time to convert your asset to cash? You might have a giant tax problem. Hi, I'm Jonathan Howard from SeaCure Advisors, and today we are going to be talking about tax planning strategies for sudden income events. So let's get started. The first strategy I'm going to talk to you about today is qualified opportunity zone investments. A qualified opportunity zone is an area in the United States that's economically distressed or undercapitalized, and the federal government has set up provisions so that private investors can come in, invest in businesses within the opportunity zone, and receive tax benefits for doing so. This is a strategy for avoiding capital gains taxes this year. So let's say you have a highly appreciated piece of stock, you invested in Apple right before the iPod came out, and now it's time to retire and you want to turn some of that stock into cash that you can use in your retirement. Well, you're going to have a capital gains tax bill. When you sell that stock, you're going to realize capital gains. So we can take the amount of money that's causing the capital gain to be realized and put it in an opportunity zone investment. And we like to work with sponsors on opportunity zone investments, and the reason why is that what's going to happen when you make this investment is you're going to defer the capital gain bill out into 2027. So we've kind of got a lumpy couch. We solved the problem this year, but now we push that lump down, and now another lump pops up in 2027. So when we're working with a sponsor, they're going to do a return of capital. So they're going to do a distribution prior to 2027 in some amount that's going to cover some of, all of, and maybe even a little bit more than the tax bill that you're going to face that year. So the investment itself will create the payment that will pay for the tax bill. Then you're going to stay invested for 10 full years, and at the end of the 10 years, your original investment plus any gain that's in there is going to be 100% tax-free. So that's qualified opportunity zone investments working with a sponsor. The next strategy I'm going to tell you about today is Delaware Statutory Trusts, or DSTs for short. What are these things? Well, they're tools that real estate investors can use to avoid a tax bill on the sale of real estate because they qualify for the 1031 like-kind exchange rules. So how does this work? Let's say I've got a piece of investment real estate that I've held for a number of years. It's appreciated. I've also got depreciation recapture that I have to worry about on the tax side of things. So how am I going to do this? Well, one solution is I'm just going to buy another piece of real estate through the 1031 exchange. I'm going to sell my property through a qualified intermediary. I'm going to identify a replacement property within 45 days. And then within 180 days, I'm going to buy that replacement property, and I'm going to be able to defer my entire tax bill out for as long as I keep doing these 1031 exchanges. But what happens if I don't want to actively manage property anymore? It can be very expensive and time consuming to manage real estate. So what happens if I just want to be done with that? Well, that's where DSTs can come in. So a DST is working with a private placement sponsor to find Delaware Statutory Trust properties where you have a specially licensed trustee who is qualified to be the trustee on Delaware Statutory Trust, and it's their responsibility to manage the property, not you. So now you can take the proceeds that you've gotten from the sale of your investment real estate, still working with a qualified intermediary. You have 45 days to identify a property and then 180 days to invest in the DST. So you have some time to find something that you like. And you can even take an investment in a single property and turn it into multiple DSTs so that you can then stagger how you exit real estate, or you can simply diversify and de-risk a real estate position. And also, very importantly, just like normal real estate, DSTs qualify for the step up in basis at death. So you can keep on using DSTs, maybe even for the rest of your life. And then when you die, any appreciation in the value of these real estate investments, all that tax you've deferred, it goes completely away. It's part of your estate, and it passes to your beneficiaries, and they receive a step up in basis and owe no taxes at all when they liquidate those holdings. DSTs are extremely powerful for real estate investors. The next strategy I'd like to tell you about today is the Deferred Sales Trust, also a DST similar to Delaware Statutory Trust, which is confusing. But just remember, if it's not confusing, it's probably not tax planning. So, what is a Deferred Sales Trust? If you've got a business that you're selling or appreciated real estate, and this will not work with highly appreciated stocks, so we're just talking about tax planning for business sales and real estate sales here. You can sell that business or that real estate through the deferred sales trust framework and then defer the tax bill out to a number of years, 10 or more years. And the reason why this is important is that instead of having a big bill hit all at once, you can now have that bill staggered out over a number of years, so there's less money being taxed at your top marginal tax rate every single year. So very complex to set these up. There is a law firm that will have to be hired to set up the trust itself, and there has to be a third-party trustee who's managing that, and then you also have a manager, a money manager, who's going to be managing the funds within the trust itself, according to an investment policy statement that's part of the trust work. So, not simple by any means, but conceptually, all you have to remember is this. You're going to take a big one-year tax bill and spread this out over a number of years so that your tax brackets are being managed to pay more tax at lower rates over a longer period of time. And that is how a deferred sales trust works. So that wraps up our look at some tax strategies for sudden income events and just high taxes in general faced by accredited investors. I wouldn't recommend any of these strategies for do-it-yourselfers. You're going to have to work with qualified professionals who are experienced in these strategies. You're going to want to look at cost-benefit analysis and definitely understand the liquidity risk that these strategies present. Know what you're getting into. Talk to people who have used these strategies before, ask them lots of questions, go in with open eyes, know the liquidity risk, the investment risk, the audit risk of what you're about to get into. If you'd like to learn more about these strategies or the other tax remediation strategies that we offer, please do reach out. You can schedule a meeting with me on our website, or you can call me at 877-328-4037, or you can email me at info@SeaCureAdvisors.com. I look forward to hearing from you soon, and have a great day.